Hey guys, so in this video I'm going to give you a complete walkthrough of how to trade supply and demand with liquidity zones. This is a new entry model which you can study and test out yourself, so I'm going to break it all down for you. So there's three components of this strategy that you need to understand. That's market structure, trend phases, and supply and demand. So even if you already know these, I recommend watching anyway just so you have a more mechanical way of doing it, because I don't think a lot of people are teaching you how to do it mechanically. And it's always good to trade objectively rather than subjectively. So let's start with the first component, which is market structure. So I focus primarily on swing structure because this is the strongest and clearest form of structure you have. So as you can see, we have bullish and bearish swing structure. This tells us what the market direction of the current trend is. We can identify this by looking for swing highs and lows in the market, as we can see here. So we know we are in an uptrend when we have higher highs and higher lows, and we know we're in a downtrend when we have lower lows and lower highs. So we also have something called minor structure, and this is simply all the little movements that we have in between two swing points. So this is important to us because, as you can see, the market has two phases. We have the trending phase when price is moving in line with the current trend, but you can see here as well we have these small pullbacks in the market, which are our retracement phases. So let's say we are currently in an uptrend in the market. You can see that price is moving up. So we want to ideally look for longs to trade with the trend. So the ideal place for entry would of course be right down here at the bottom of the retracement, so we can ride our trade in line with the current market trend. So that's where minor structure comes in handy because it helps us time our entries better. So let's take a look at how we can do this. So minor structure has two main purposes. Number one is to help us identify our strong swing highs and lows. Like I mentioned earlier, we want to be able to do this mechanically or objectively rather than trading subjectively. So the method I use for this is to simply follow minor structure until you have a break in minor structure. Once we have that break, that's how I know I have a strong swing high. Then you'll usually see that the minor structure is heading down, but that doesn't mean that we are in a bearish trend. This simply means that price is currently retracing, but the overall swing trend you can still see is bullish. So as we discussed earlier, we know that if we are in an uptrend, price will continue with the trend and then have a retracement before doing the next leg up. So if we are in an uptrend, we want to wait for the minor break to show us that the retracement is over and to signal to us that it's a good time to join in on the bullish trend and ride it to the creation of the next swing high. So we do this by simply waiting for a break in minor structure. This is the best identification that the retracement phase has probably stopped. Of course, it's not 100% certain, but it gives us higher probability that the retracement has ended and price is likely to continue with the current trend. So that's how you get into a trade if you're trying to follow the trend. But we have another type of trade we can take. Now that we have a good understanding that we have two phases in the market, the trending phase and the retracement phase, we can also capitalize on the retracement phase. That means we know that the next phase is going to be a retracement before the market continues to create the new swing high. In this case, you can do the same thing. We know that the minor break will signify that the retracement has started, and after we see that minor break, we can take shorts until the retracement is finished and then wait for longs again to trade with the trend. Now you might think that retracement trades are against the trend, so they're lower probability, but the way that I like to stay conservative with retracement trades is by using premium and discount ranges. So to keep it super simple, we know that we have a swing low and a swing high here. So if you are taking shorts during the retracement, all that I'll keep in mind is that a retracement typically happens to about 50% of the range. So that's between the swing low and the swing high. So I would not take any more shorts once we have gone past 50% of the range. And after we've reached 50%, I would only be waiting for long confirmations to enter on the next leg of the trend. So let's go through a little walkthrough on some actual price action. So I have an example here with just the swing structure marked out, and then on this side I also have the minor structure marked out. So when you start mapping up your structure, you want to start with a clear high or a clear low in the market. So you can identify this very easily by just looking at a high point in the market and look to the left if it closed above the price action to the left. If it did close above everything on the left, that means this is very clearly the highest point in the market. So now that we have a swing high, we actually need to identify our previous swing low. That way we know where our breakout structure in the market is going to be. So to do this, I simply follow the minor lows in the market until I find the lowest minor low. So I've already drawn out our minor structure here for you to make it simple. You can see here that this low is higher than the previous low. So you keep following it until you reach a certain minor low that fails to close below the previous one. So you can see here this minor low is a lot higher than this one. So we know for certain this is the lowest minor low. So therefore it was a low in the market, right? So you have the swing low, you have a swing high, and you wait for a breakout structure. After that, you have your first swing range. Because of the breakout structure, you know that the trend is bearish. So you want to wait for the next pullback so you can get in on the next leg of the bearish trend. So how do you do that? Once again, and you would follow minor structure until you can see here, price goes above and breaks that last minor high. So therefore, we now have our new swing low. Once we have our new swing low, we simply wait for another break of structure. Once you have that, you know that the highest point between the swing low and where the break of structure happened is your swing high. And you just continue following price like that. So if this isn't making sense to you, I really recommend just opening up the charts and trying to identify your swing highs and lows yourself, because just practicing and studying price is the best way to learn how to read it. And feel free to drop your markups in the Discord so I can review them. But let's move on to the next component now, which is supply and demand. So this is my mechanical process for identifying supply and demand. The first thing I look for is an impulsive move. So the way we can identify impulsive moves in the market is to simply just look for a gap. It doesn't matter how big or small it is, I just want to see a gap has been created like this. You can also just identify this as a fair value gap. But in case you don't know what fair value gap means, then it's literally just a gap. So you can see the wick from the previous candle closed here, and then the next candle wick was over here. So between these two wicks, you had this gap over here. So in the case of identifying a supply zone, you want to look for the last buying candle before the gap was created. In this case, it's going to be this bullish candle, and then you have this impulsive candle here. So this zone is a valid supply zone for me. Now in this example, you can see that we had that fair value gap over here between this candle wick and this candle wick. However, this impulsive candle was so huge that even this previous candle here has created a fair value gap as well. So if we look at this example here as well, you'll see another example of a massive impulsive candle where you can see this fair value gap was formed here. But there were so many candles that were valid within this fair value gap, right? So you can call this the last buy move before this impulsive move down, right? But I actually do not accept huge zones like this because logically it doesn't really make sense to consider so many candles that are making such fractal movements up and down as the last buy move before this impulsive candle, because there's just no way to determine this was just a whole buying move because there were so many movements up and down within it. So it's just not logical. I do see a lot of traders trying to take huge buy zones whenever they see this kind of impulsive candle. But for me, my rule is I will use maximum 2 candles before the impulsive candle if there is a large candle like this. So in this case, you can see this bearish candle as well could have fit within this impulsive move as the last buy move before the impulse. But I keep it strictly to just the last 2 candles before the impulsive move. And I would never use this huge buying range before the impulsive candle. So for this example, the correct way to draw the supply would have been to simply just use the previous candle over here and have this massive gap down here. So this is a way more refined and conservative supply zone. So I want to share one more example with you. You can see once again we have this fair value gap, which shows this impulsive candle over here. Now before that, you will see there are actually no bullish candles. However, I have drawn my supply from this candle. Even though it's a bearish candle, what we can see is that price went up before it impulsively came down over here, right? The impulsiveness started with the creation of this gap. So I will still accept this as the last buy move before the impulsive candle, because the color of the candle doesn't matter. You want to look at the movement of the candle, what it actually did. So you can see from the candle close over here that this bearish candle closed right here, then price actually went up to form this wick before coming down. So this does count as a buying move before this impulsive leg down. So I know those were all examples of supply zones, but you would just flip everything around and the exact same rules would apply if you were looking for a demand zone. So everything we've talked about until now, I apply it to the 4-hour time frame. Once price has reached my valid supply or demand zone, I head down to the 15-minute, which is where I would look for this entry model. So picture all of this happening within a 4-hour supply zone. So when we go down to the 15-minute, what we want to see is that price is obviously heading up into the 4-hour supply. Then we want to see a minor break in structure on the 15-minute. We want to see if price left behind a supply zone, which it often does. So most traders will see that minor break and that supply zone and will be looking to enter as a reaction to the 4-hour supply. But for this entry model, what we will be waiting for is a liquidation of this first supply zone. So we will not be entering from here, but we'll be waiting for price to head above that supply zone. So at this point, the supply zone has failed. Obviously, the strategy is called liquidity zones. However, we don't know this has been a liquidity zone yet. We only know it's a liquidity zone if we have a second minor break after that first supply zone has failed. That means price went up intentionally to sweep liquidity before heading in the true market direction. So it's only after this minor break that we can look for entries. So after I see that first supply zone has failed, that's usually where I place my limit orders on that minor break, because if it wasn't a valid liquidity grab, price would just continue away from our entry and we could cancel that limit order. But if it comes down, that means it was a liquidity grab and we want to get tapped into that so that we can get in on the breakout when price moves in the intended market direction. Once I have my entry, I target a 1 to 3 with my stop loss at that high of the liquidity grab, and that's it. So let's do a walkthrough of this recent trade example on GBP USD. So we're on the 4-hour time frame. We want to start with a clear high in the market. We know this is a clear high because we can see that obviously this wick is a lot higher than all the price action that happened on the left. So all we want to do now is follow the minor structure until we find the clear minor low in the market, which is right here. So we can see that this minor low clearly closed below this minor low over here. And we even had a break of that last minor high, which actually started this swing leg up. So just to make that all nice and clear, we have a clear swing low in the market. We got a clear swing high because we have that minor break over there, so we know that's the swing high. I'll just mark those two minor breaks over there. So what this gives us is our bearish break of structure. So now we've identified the market direction. We know that price is bearish, so we want to see if we have a swing low in the market. A minor high break would be over here, which would confirm that this is our swing low. So let's play price forward, and what we see is we have that minor break, which confirms this is the swing low in the market. So we know price is bearish. We now have a swing low, which means this is where price is heading next, so that we can trade with the current market trend. So I can draw in my swing range here to help me out. I can see that the retracement is complete because we reached above 50% of the range. Once price has reached 50%, I would not continue looking for retracement trades because it's a much lower probability since the current trend is bearish. However, because we're following the trend, we are looking for shorts. Let's say price is below 50%, I would still look for shorts because it's in line with the overall market trend, so it's a lot stronger. But if I continued looking for longs up into, let's say we have a supply zone over here, I wouldn't take longs or retracement trades from the demand zones that form here, because they are counter trend. This price is bullish and you're really looking for longs above 50%, so it would be much lower probability. So I hope that was clear. So anyways, now that we know the market direction, we know the timing of the market, so the retracement is complete, we need to look for valid supply zones which we can trade out of. So if we zoom in here, you can see we have this impulsive candle over here, right? So you can see this wick and this candle close creates this gap in here. So this is our valid 4-hour supply zone. But remember the rules we discussed earlier. We can take 2 candles before the impulsive candle if they are part of that buying move up. Obviously this is a bullish candle, so you could draw your supply zone a bit bigger like this. It's completely valid as well, or you can refine it to just this single candle here as well. So actually if we look at where price currently is, you can see we have an impulsive candle over here as well. And even though this candle here, the candle just before the impulsive candle, it isn't a valid supply, but if we use our 2 candle rule, you'll see that this candle is a valid supply candle. And I'll zoom in so you can see better. This candle is a valid 4-hour supply candle. And you can really zoom in here to check that it closed above the previous candle to be a buying candle. Or I have this open, high, low, close little indicator on TradingView, which will tell you the exact price. So if you just hover over the candlesticks and then pay attention to what the high of the candle price says. So this one is 266. This one is 267. So that is a quicker way to confirm that this candle indeed went above the previous one. So it is a valid buy before the impulsive selling. So that's a quick way to do it without having to zoom all the way into your chart. But anyways, we have a valid 4-hour supply here, which is kind of in line with the 50%. So now what we can do is head to the 15-minute time frame and let's see if there was a valid entry over here. So you can see that price came in over here. We had the minor break over here, but price continued up higher. So the minor break moves over here, but it doesn't leave a valid supply in this move. Price moves down. We have a 15-minute supply over here, so you'd want to see a liquidation of that 15-minute supply. However, if we play price forward, you'll see that supply zone holds and price actually heads down lower, which is completely fine. There was no entry from that 4-hour supply zone. And then let's see what price did now. We see that we have stronger confirmation now that the retracement phase is over and price is heading down lower. We had that 4-hour minor break as well. And you can see we have an impulsive candle here, which leaves behind this 4-hour supply. So now let's wait for price to tap back in. It went a bit quick, but let's go to the 15-minute and see what happened inside that 4-hour supply. Which is a little bit messy in here, but price came in. You could argue there was a minor break here, but there was no supply left behind, so you wouldn't look for anything anyway. Price goes up, creates this high. The minor break would be here, but price just comes down and then goes back up again. Then you had the minor break over here. Now I know this is quite nasty price action because it's just a massive gap, but technically that is a minor break. However, there is no valid supply formed over there. So continue, and then you see this 15-minute supply got formed over here, and you have this 15-minute supply over here. So at what point do you stop looking for that liquidity zone? I would say when you have the second minor break, because at that point price has already reacted to that 4-hour supply, so it'd be better to wait for a new 4-hour supply. But let's see if price gives us a reaction before the minor break here. So early wick below, we didn't get the candle close, price went up, liquidated both of these supply zones, so that's even stronger. Of course, the extreme zone is a much stronger liquidity grab. Price continues going above, but what we are waiting for is simply a minor break where we can take our entries from. So you can see as price moves up higher, you just continue waiting for that minor break, and it pushed up even higher, and Every time it moves up higher, you would cancel your limit, place it on the next minor break. The stop loss would go above wherever the current high is, so that's the high of the liquidity grab, and you would be targeting 1 to 3 risk to reward. And then let's see if we get tagged in. This time you get tagged in, and let's see, price heads down for a 1 to 3 risk to reward. And let's go on the 4 hour again. Just want to show you that we did later on have that break of that previous swing low, so the bearish trend was still intact, and then you would wait for retracement and continuation again. So I hope that clears up the process of trading supply and demand, but using liquidity zones as an extra confluence or confirmation for your entries. So if you have any questions about the strategy, or you want to follow along with my analysis and my trading progress, you can find me in my free trading Discord.